We have time for one last question, and I'm going to take my prerogative as chair to pick Susan Wachter from Wharton, who's one of the Social Science and Policy Forum advisory committee members and also an expert on these matters.
And I'll stand around.
And then, yeah, we could definitely have much time for informal questioning afterwards.
So, fascinating talk, and a lot of questions that I have, which perhaps will be another opportunity. But in particular, I think there would be a different narrative, and there certainly was a different narrative as this was proceeding. And it still is, I think, among financial economists. I mean, I am going to pull myself back and say I'm observing, because I actually disagree with this explanation. But their explanation would be that there was an optimal shift to less constrained lending. There was financial innovation that was real. And that the constrained lending for housing in Europe, for example, where there were segmented housing markets, there was allocated credit, was not efficient. And therefore, removing these constraints, integrating, and allowing people to become homeowners was definitely a positive and would actually lead to less imbalances and more stability going forward, because it would allow people to borrow against this asset, which is the home. And then we had automated underwriting systems, which there weren't before. So while this was happening, this was the, yes, there was an innovation, there was a technical innovation. So it's simply saying, well, whenever debt goes up, we have a problem, because we all knew debt was going up. It's not a problem. Now, in 2005, I was saying it was a problem. And some of my work goes directly to that. But where I go, which is different from what this received is saying that at the same time there was a huge increase in opaqueness, increase in obscurity. And so you have to recognize that was happening. You've given the point to that. And you've also said, but it isn't just about structured finance, because look at Spain. But I would say Spain is exactly an example of obscure finance, actually, because no one knew it was happening to us at the time. So.
Yeah. Well, I think I would certainly agree. One aspect of what you're saying is that it's wrong to think of debt in and of itself as a problem. And, you know, there's this sort of view out there sometimes when I give talks or blogs and things, people come in and talk about financialization and the evils of financialization. I don't think financialization, I don't know what financialization means really, but if we think of financialization as being expanding the range of financial instruments available to both the public and private sector, it's a good thing. You know, you talk about access to debt being bad, well, try to tell that to people who are credit constrained, whether they're students or potential homeowners or consumers who should have access to more credit. So I certainly agree with that. Debt in itself is not a problem. I think that what happened largely here was that it could be thought of in a number of ways. First of all, there was overshooting. That is, in the liberalization of these financial markets, you had, in the European context in particular, you had way more debt expended than made sense, and that would have made sense from a national standpoint in the case of Spain, largely because it was not, I mean, the Spanish government really didn't know what the level of borrowing was at the time. There was virtually no monitoring of both the, I mean, there was the view in the EU, or within the Eurozone in particular, that current account deficits could not exist and could not matter. And we now know that's not right. We now know it matters if Germans lend $1 trillion to Spaniards. Right? Even now, within the context of what that money is being used for, and again, you're right about the opacity, but I think the fact that we know that there is hurting in financial markets, we know that there's a tendency for them to overshoot on the upside and on the downside, and we know that liberalizations that are not careful about putting in place fire breaks that can mitigate both the overshooting and the bank run possibilities can run into difficulties. Again, I'll draw a comparison. In Latin America, there was a big literature on the optimal sequencing of reforms, right? And virtually all the work that was done concluded that it was a big mistake to liberalize financial flows first, right? Because you got this overshooting. You got massive flows in, and then you got bank runs out. And I guess what I would say is the flip side, and it's consistent with what you're saying, the flip side of the notion that, well, we want to liberalize finance, make it available, but you get overshooting, is what Gary Gorton has pointed to in trying to explain what happened in 2008, which is that now people don't use banks to save, and to move money. They use these markets, sort of structured finance and other economic instruments. And we had in 2008 a classic bank run, only it wasn't a run on banks, it was a run on markets. And just as you had massive flows in that overshot what made sense at the time, you had a run on the markets that exacerbated the impact of the crisis.
So among the work to be done, and you set out a good set of work for students, that question of how to monitor, how to track,
Right.
is very much in the
Absolutely.
minds of regulators. It's not clear at all. We just had Don Trullo here last week, who's the governor in charge of this in the Federal Reserve, said, we don't know the answer. We have PhD students who can work on this and raising this because
there are no easy, listen, if the answers were easy, then these things wouldn't happen.
Right.
I think I'm a big fan of the comparisons, and I think a great dissertation topic would be to look at something, obviously not something that's happening now, but perhaps a retrospective on the response of countries like Canada or Australia to similar conditions in the more recent past. I think Canada is a fascinating case, for example. I mean, Canada is about as close to the U.S. as it can be. It has a very different financial system, and it has a very different regulatory
I
structure.
agree. I've done some work on that. So, but I'm literally saying any of you here who have such interest would speak to Tom.
Yeah, and I'll look forward to reading that dissertation.
Absolutely. I think this is a perfect way to end our conversation today, which is giving all of you a research agenda or multiple research agendas to move forward with social scientific engagement and policy. I have an announcement to make before you all went out the door, but first I want to thank Jeff Frieden for this immensely stimulating presentation.